Hi, everyone. This is Jason Bjork of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He worked with Doug Casey and was his protege for many years. He was a paid investment newsletter writer and a editor at Casey Research, I think for 14 years. He currently travels all over the world looking for new natural resource opportunities. Lobo Tiggre, thank you for joining me again.
Thanks for having me back on the show.
So, Lobo, we're recording this interview on Wednesday, October 4th, 2023. The gold price and the silver price in US dollars, they've gotten clobbered in the last couple of weeks. The gold and silver prices in other currencies are actually doing very well. But first, I want to get your thoughts, though, before we start talking about maybe natural resource opportunities on interest rates. And how do you think higher interest rates, the Fed hiking interest rates at a record pace the last 12, 14 months, has affected the natural resource industry, mining companies, oil and natural gas companies?
Well, less than you might have thought, but I think that's coming. So I don't want to sound like Linus waiting for the great pumpkin in the pumpkin patch. And I'm not necessarily promising the great pumpkin, but the answer to your question is, and this isn't original to me, a lot of people have pointed this out, that the record pace of tightening, we would have thought that the Fed would have broken a lot more than it has. And people have been scratching their heads. You know, some people might say, oh, well, the Fed increased interest rates 5% back in the Volcker days. Yeah, but they did it from 15 to 20. So as high as 20 is, that's only a 30% increase, whereas going from 0 to 5 is practically an infinite increase. So, I mean, this really is unprecedented. It really does seem like more should have broken, which might have been bad for industrial minerals, but should have been good for safe haven assets like gold and silver. And we really haven't seen that yet. So is something wrong? Have the laws of economics changed? I don't really think so. I think that many of us underestimated how much of the low interest rates were locked in. You've got, homeowners, for example, who locked in low mortgage rates and now they're not selling, and that's causing interesting conundrums in the real estate market. But that insulates them from higher interest rates. The fact that that very large chunk of their family budget is locked in at a low rate. And companies did the same thing, even though everybody talks about how great everything is. The CEOs of a lot of these companies, they're not dumb. They can see the Fed increasing rates. So I think it's pretty well established that a lot of the companies took the chance to insulate themselves as they could. So that rolls off, though. That's, at some point that rolls off. The refinancing won't be happening at anywhere near the prior levels. And then I think we start seeing things start to change. And as we're recording this is an interesting time with the 10-year approaching 5%. A lot of the talking heads on mainstream financial media are starting to finally notice this. And you hear people talking about how, that soft landing scenario is kind of out the window. People are talking about how bad the recession will be. People are talking about the bond vigilantes. It seems like they didn't retire after all. And people are talking about the Fed breaking more things. So none of this really should be surprising. If anything, it's surprising that people are surprised. The laws of economics don't change. But to be fair, I don't think anybody really appreciated how long these long and variable lags would be. Even I didn't appreciate, even I don't mean that to sound in a self-aggrandizing way, but I'm just including myself. I'm saying I too didn't think it would take this long before the Fed would break something else. But I do think it's happening, and I do think it has consequences, good and bad. For safe haven assets, primarily gold, I think it's very good when the writing on the wall becomes clearly legible to all. But for your industrial minerals, I'm considerably more cautious. If we're going into recession, those always get whacked. And the one possible exception could be uranium, which maybe we'll talk about a bit more later.
Yeah, I have it in my notes. For our listeners out there, the yield curve, it was deeply inverted, I think, for over 220 days, close to a record amount, either record amount or close to a record amount. So it was getting long in the tooth there for the lag effects, like you said. But I think there was, in the real economy, I think it's bifurcated. So you have a lot of more affluent people who are making $500,000 or more who don't have a lot of high interest rate debt or locked in a lower interest rate mortgage, like you said. A lot of corporations were they had already locked in lower interest rates. They didn't have a ton of variable rate debt, or when they did, they were able to refinance maybe at lower rates, get some type of deal that the rest of us could not. But for the Main Street people, the people who are not earning $500,000 a year, who have auto loan debt, student loan debt, maybe a higher mortgage, a higher rent, they're getting killed with stagflation and shrinkflation and taxes in their small business, or at the family level or consumer level. Those people are the ones getting hurt in the real economy. So I would say the real economy, because of the Fed policy of the rapid rate hikes, it created a bifurcated economy and enormous distortions.
I agree. And it's interesting, back in the immediate post-crisis mode back in 2020, and actually also after 2008, people talked about K-shaped recoveries. And then that sort of went out of fashion. But I think that is actually pretty accurate for what we're seeing out there, and this division between Wall Street and Main Street. And we all know that's untenable, right? You simply cannot have two halves of the map or the street going in different directions before something breaks, something tears. And without getting too philosophical about that, I think that's coming, and I think it's coming soon. I'm on the record saying that I think the Fed will break something else before the end of this year. Not a lot of time left for me to be right or wrong about that.
Well, but I'd also argue, Lobo, that asset prices have become more and more distorted every 5 to 10 years, really, since the tech bubble. And then things just went absolutely bonkers in 2008 with the quantitative easing and central bank balance sheet programs. So like the asset prices for stocks, bonds, real estate, it just got super, super inflated with central bank balance sheet expansion and zero interest rate policy.
I agree. But you know what's really scary about that? You look at that, and we talked about how unprecedented and breaking the charts things done in 2008, 2009 were. Now you look back at those same charts, the Fed balance sheet, the debt or the national debt, or these things, and those things are like blips, or, in many cases,
well, it's negative compounding, right? So here we are, we added $1 trillion to the national debt in 3 months lately. It's just getting
exactly.
It's a bad math now. The math it's a runaway train on the interest payments on the debt and the national debt.
Here's the thing, though. We look at that, and what was previously unprecedented now turns out to be a foothill of a greater peak. And every time something like this happens, when it's tempted to say, "Oh, this is it," the system is falling apart, the wheels are coming off the wagon, the train is going off the cliff, or the tracks are pointed off the cliff, whatever metaphor you want to choose. But we've heard that before, and somehow the powers that be have managed to kick the can down the road. So I don't want to get up here and tell everybody, yep, it's time to head for the bunker in Idaho, batten down the hatches and check your ammo. It might actually be that. I'm not saying no, but I don't want to say, yes, this is it. World War III is launching tomorrow.
Or hyperinflation in 12 months or anything like that. Yeah, exactly. I mean, they've kept things in I would argue they've kept things in pretty much lower levels of stagflation and directed most of the monetary inflation into assets for the last 15 or 20 years. It's pretty remarkable what they've been able to accomplish.
Yes. I'd say two things. One is, you absolutely do not want to be caught short if they lose control. Like this incredible balancing act, as you say, 15 years. I just think of that as the most recent installment since 1971, actually. But anyway, you don't want to be on the wrong side of this. If we're right, and if things blow up, or whenever they blow up, maybe it doesn't happen for another 15 years, but whenever it happens, you don't want to be unprepared. It is not a speculation, in my view, that I own gold bullion. In my view, that is long-term real savings, my financial long for which there is no short. That is my safety and my insurance policy. And I hope I never use it, honestly, but I'll sure be glad when I have it. And you can't buy insurance after the fact. So that's main point number one. The other thing, number two, is if they do kick it down the road, what does that entail? What would that mean? There is no way to kick the can down the road that doesn't mean a lot more fiscal and monetary largesse. That is incredibly inflationary. It's incredibly bullish for all commodities. And you remember, and I said, if we're going through the ringer, I don't want to buy industrial minerals first. But if they do kick the can down the road, I want to pile into the necessary, not just the newfangled, battery minerals, everybody's all excited, but any necessary real thing that makes the economy go. And I'm thinking Dr. Copper to begin with, is of enormous interest to me in that scenario.
So I want to circle back to interest rates and commodity prices. So we actually had high gold prices, relatively high in US dollars, although they're higher obviously in Japanese yen. I think the gold price in Japanese yen is at an all-time high or near an all-time high, and they have insane demand and premiums right now. We had high premiums in China for a while too, but that corrected, I think, in the last week or two. Anyways, though, did it look like there was a bear market for a lot of fundraising for a lot of juniors and natural resource companies? Because wasn't the Denver Gold Forum only a couple of weeks ago? And I had friends there who were running companies or newsletter writers. And I was just hearing the stories about how empty the Denver Gold Forum was and how little interest there was in any gold mining, gold stocks, juniors, the generalist fund managers that were there. So these are like the large institutional investors that buy stocks, bonds, maybe a little bit of gold. They only seemed interested. The only gold stocks they really seemed interested in were the royalty companies. So despite metals prices, would you say that like the because of the higher interest rates, that the gold companies, the miners and the juniors, it's been a bear market for a couple of years now? Would you agree with that?
I wouldn't call it a bear market for a couple of years. I would agree that the sentiment now, I should say, I didn't go to the Denver show. I've never been. It's focused on one-on-one meetings. And I don't have a hard time getting meetings. I'm a newsletter writer with an audience, so the companies return my phone calls. I've never found that to be a particularly great use of time. But you can see it in the financings or the lack thereof. Or let me put it this way: the news of financings in the last month or two has been all uranium companies, because those stocks have been going nuts. And bully for them. It makes sense if your stock's looking at a 52-week high or a multi-year high. It's the right thing to do to raise money in that environment. You can do so with less dilution for your shareholders, but you're not seeing it on the gold and silver side or the copper side. So if the money talks, then it's telling us about the sentiment. And if you look at the indices, the GDX, GDXJ, and so on, they have not enjoyed the benefits that gold has had. They haven't held on as well. And if you price the gold stocks in gold, for instance, then those alligator jaws have opened again in a big way. So there are several ways of looking at this. I think you're spot on. This is exactly the case. The good news, if you want to look for a gold lining on this, is that it will help separate the wheat from the chaff. This is kind of a litmus test. Actually, this is, or maybe a compass is better, a metaphor for your average resource investor out there. If you have a hard time distinguishing the really best of class type plays from some of the ones that are just really good at talking up a great story, well, look at who can finance in hard times. If companies have projects of real merit, if management has a really strong record, and everybody makes their record look great, the bios all look wonderful if you look at the bios. But the real McCoys, the ones out there who've done it repeatedly, and the industry insiders know it, they don't have trouble raising money in a market like this. So when you see somebody who can raise funds on reasonable terms, no 5-year warrants or anything like that, maybe half a warrant or no warrant even, if they can raise money in this market, that tells you a lot about the quality of the company.
That's less than 10% of all juniors, though. I would say 90% of the juniors out there can raise little to zero capital. I mean, some of the deals, Bonterra already had infrastructure in place because they were mining. They have a mill already there and a permit to grow it. They couldn't even raise, I think, 5 million. So they just sold, they allowed Osisko mining next door. And Osisko has an amazing project in Quebec. They had to get a joint venture partner, Goldfields, to help build 50% of the mine. And that's in the most mining friendly jurisdiction, I think, in the Western Hemisphere, Northern Hemisphere in North America. So, I mean, there's just examples of this where you think, wait a second, this is in a pro mining district. You think they'd be able to raise at least $5 million for some drilling and wait this bear market out, and yet they can't. So I don't know, it's just kind of head scratching.
I don't think so at all. I think you're being generous to say that 10% of them could raise. I think
well, it's even less than wow. Yeah.
And okay, so Canada's a good mining jurisdiction. Quebec's a good mining jurisdiction. That doesn't mean every patch of ground there is the best. I mean, look at Red Lake. It's one of the best places in the world to look for gold. And the complexity and the folding of the zones and so on makes for, in the right place, tremendous deposits. But that same complexity also can make it very difficult to drill off and define these things or nail them down. It's a place where, some of the biggest cash cows in gold have been put into production. And it's a place where people have broken their pick repeatedly trying to put something into production that really shouldn't have been. So,
oh, that's interesting. So which are the successful mines up there? Is that like Detour Lake or Canadian Malartic?
no. Red Lake, I'm being very focused. I don't just mean Ontario in general. I mean the Red Lake mining district where Goldcorp was focused, and the Red Lake Gold Mine, Campbell, those things. And then and I'm sorry, but I try hard not to give away company recommendations. So I don't want to talk about current players, but I could mention, for example, that Pure Gold was a company that went to the Red Lake district and broke its pick there. Another one no longer existent is Rubicon that went to Red Lake and broke its pick there. So the district alone, it tells you this is a good place to look. It's a good box for a company to tick, but it's not enough to say invest here.
Oh, okay, I see. So it seems like the companies, these juniors, are really good at marketing and spinning tails, and then they do raise capital to drill, and then even then they still don't find a lot of stuff, or they waste a lot of shareholder capital just drilling.
Or they do, and their studies are optimistic, and they build mines that shouldn't be built. And that's the worst, because exploration is tough. I have patience for companies that, they give it their best shot. They had a good theory. They drilled it. Wasn't there. Fine. It happens. It happens to the best in the business too, by the way. But if you lean on your engineers or your qualified person to sign off on a 43-101 that has excessively optimistic assumptions, and then it turns out that that's not reality, you do everyone in the sector, including your shareholders, a great disservice. And I don't think that happens by accident.
So these large gold miners, they're producing an enormous amount of gold. Their costs are going up. Their profit margins are getting squeezed right now with higher input costs. I think Newmont Mining, their costs only 3 years ago in early 2020 was around $1,000 an ounce. Now it was just under $1,500 an ounce. So just an enormous spike. How do you think these larger miners are going to replace a lot of their reserves and these deposits that have been in production for 10, 20, 30 years?
A lot of them still have plenty on the books, so I hope they won't be in a hurry to do that. But it's interesting, for all of its troubles, and I'm not recommending the company, as I just said, I try to avoid company specifics, but I remember Goldbugs just lavishing the hate on Mark Bristow at Barrick because he wouldn't budge on designing mines around 1,300 an ounce gold. And if it couldn't work at that level, he didn't build it or he didn't buy it. And people got frustrated. Gold's at $2,000 or whatever it was, and they got mad at him. And now it's still higher, but costs have come up so much. As you say, if Newmont can't keep costs to under 1,500, then good for Barrick for sticking with their 1,300 limit. And again, Barrick has issues. I'm not recommending anybody buy Barrick. I'm just using this as an example for why industry practices are to use long time averages or low metals price assumptions. When you see companies that build a mine or even just publish a resource using something that's very near current spot prices, that's a red flag. It's not realistic. Even if you're a bull, so many gold bugs were excited because gold goes to $2,000 because of high inflation, but they forget that mines use energy. Mines use steel and equipment. Mines have costs too. So, the best time to be in the miners, and remember that gold itself is a separate question from speculating on the miners. The best time to be in the miners is when the metals have moved, but costs haven't caught up yet. But eventually, inflation affects everything. So.
Yeah, I totally agree. There was in 2020 and 2021, there was almost an 18-month window there where the input costs were not rising. Now you have higher interest rates, higher energy prices. Diesel was an absolute disaster for costs for a lot of these miners, especially the open pit miners, because they're using insane amounts of diesel to move those giant earth mover trucks 24/7, 365 on all those different shifts. But then the other issue is a lot of these mines, Lobo, are in emerging markets. And against the dollar, these other currencies are devaluing, and then the labor costs are going up. I think Newmont Mining put out that their labor costs were up 50% in the last couple of years. So the labor costs of a lot of these emerging market mines are up enormously, and metals prices are not.
Yeah, that's interesting because it's not a linear progression. It's not just the bottom rungs of the socioeconomic ladder coming up, though that is happening, and that's not a bad thing. And it's not the wage price spiral like, per se. It's not just, inflation is up, so workers are demanding higher wages. So that's part of it too. Uh, there was a huge change post the COVID. I mean, when those COVID lockdowns happened and people got generous support, and not just in first world countries, this idea that work is optional, or maybe that work is something you only do if you have to do and you have no other choice. I mean, I can't put my words in the psychology of different people in different places from different cultures. I can say that around the world, after the COVID lockdowns, labor costs, it was really hard to get anybody to work. And now that the COVID situation is resolved, that difficulty persists. It's not work from home exactly. Obviously, that doesn't work for a mine. You can't mine from home unless you're a remote truck operator, perhaps.
Well,
But
not yet.
you know
Yeah.
what I'm saying, right? There's a shift out there, I think, and maybe this is above my pay grade, but I perceive there to be a global shift in the labor markets for where labor costs are going higher. And ultimately, this will push commodities prices higher. It has to, or there won't be the commodities. So unfortunately, that kind of push me, pull you tug of war between commodities prices and input costs. There can be sadly long and variable lags between those pieces happening. But at the end of the day, if you can't make money mining, you won't mine, and goods will become scarce, and low prices will cure low prices. So for the patients, I do think that we are looking at much, much higher commodity prices for the long term.
Yeah, I agree. The cost to bring on a new mine, especially at these interest rates, cost of capital. If you're an investor out there, you're looking at putting money into a money market fund or short-term US treasuries. Miners are competing against that. So the costs to build a new mine are going to be enormous, especially when you add in all these extra input costs for energy and labor, in addition to cost of capital. So the cost to build some of these new mines, and I know you've been traveling all over the world lately looking for new mining opportunities. Do you think that the cost to build a new mine are up a lot in the last couple of years too?
I do. And it's funny. Well, it's not funny. It's actually sad. But the United States likes to think of itself as separate from the world. But the global economy is still connected. So this is an issue. And let me just say yes. And let me go off on a tangent. You didn't ask this, but there's another side of this. It's not just a change in the labor market around the world. There's also this perception, like the poor gold bugs, gold's still near $2,000 an ounce or $1,900 an ounce. It's a dream come true from 20 years ago, but costs are up so much that that's not as great as it seems. But the politicians, they don't get it either. They see metals prices at what are historically very elevated prices, and they say, we can raise taxes, we can raise royalties, we can slap new obligations. And
well, Chile tried doing that with copper, right? It wasn't on gold, though.
Right. So what I'm saying, though, is that there's another disconnect here where the politicians haven't got the memo that the costs are making what look like high metals prices actually turn what were once profitable miners into marginal operations. And if they tighten the screws on these companies, they will shut down. And they will, these guys could literally kill the goose that lays the golden egg. Well, not quite literally, but you know what I mean. It'll be too late. But once they do it, we'll see what happens.
Well,
long
Chile.
Story short, I'm just sorry, Jason. I just want to stress to people that political risk is on the rise around the world. This is real. It is potent, and you need to beware.
Oh, I 100% agree. As a libertarian, I mean, I don't trust the government. Every time, if the copper price is spiking, the politicians, they're looking at the investor presentations for the companies. The company says our cash. Remember when the gold companies used to only report the cash cost? The politicians and the people running these governments and the regulatory agencies for the miners in these different countries, they would see that. Our cash costs are $300 an ounce. And the gold price was at $1,900 back in 2011. So they assumed the miners were enormously profitable. Well, the cash cost wasn't the real cost for the miner, and the royalty taxes were hiked anyways.
Yeah, no, that's exactly right. Criminals in office may be corrupt, but they're not stupid. And there's a tendency to think that those brown people somewhere else in the world, they're not as educated, not informed, they don't know. But I have seen villagers in Africa with their cell phones, and they read company press releases. And a company press releases some discovery, and pretty soon it's swarming with illegal miners. The information goes around, not just at the government level, but at every level. So you got to take care. You got to do things right. I dislike this term stakeholders, but at the end of the day, and there's all this ESG nonsense. It's really silly, but there has always been a good reason to be a good corporate citizen, and it doesn't help yourself or your shareholders to piss off your neighbors or to piss off the locals. It's not bad business to be decent to the human beings you have to work with.
Well, for a mining company, Lobo, I think that's investing in the local infrastructure. So what the people, if you speak to the people, and I've seen documentaries about this, it was called Mind Your Own Business, and they interviewed a lot of locals around prospective mines. They want investment into their local communities. They want new roads. They want electricity, better schools, infrastructure, clean water. So if the mining company is willing to do that, I mean, I wouldn't consider that ESG. That's just good business. You're building up the local community. You're adding value there. You're spending money in the local community. You're hiring people for higher paying jobs, and then the money's going to be spent locally. So that just seems like non-ESG stuff. That just seems like good business.
I would agree, and I did see that. And it's interesting what I have seen. First, I've seen personally, like I've been to exploration projects and then gone back when the mine was built, and you see villages in the middle of nowhere. Like these people had nothing. They were scrabbling in the dirt for a subsistence living. And now they own restaurants. There's a few little hotels there. There's paved roads and streetlights. You can see the material improvement in the lives of people in these places. But the trick, though, and I always tell whenever I go to these places, and I always tell the management, whenever you give money for a new school or a new clinic or whatever this is, make sure you get a brass plaque on the door that says "Brought to you by Explorco" or whatever. Because if not, the local politicians will take all the credit for it. There's new streetlights in the town, and the locals will say, "Oh, what a great mayor we have." But it was the mining company that paid for that. And if it's not visible through taxes, that happens a lot. The mining companies pay all these royalties. Everything goes into the central government, and then the politicians take 90%.
Yeah, it's wasted or stolen.
Right. The 10% that trickles down to the people, it does a few things here and there, and the mining company gets no credit for that. So I really think that they need to wise up and make sure that they explain to the locals the economic impact they have.
Yeah, the government just starts raising royalty taxes. Like you said, one of the best examples of this is Chile and copper. So for our listeners out there who are not familiar, Chile is basically the Saudi Arabia of copper. When the copper price, I think 18 months ago, hit $5 a pound, they started issuing press releases. They were going to drastically raise the royalty taxes on copper miners. Well, here we are almost 2 years later. Chile's copper production is in permanent decline now. There's not investment into new copper.
Yeah, it's what can we say? At some point, reality does matter. And as much as many Chileans think that the mining industry was, it has an association with the military there in the past. There's reasons why a lot of people are not enamored with the mining industry in Chile, and I understand that. But it is still a pillar of that economy. And they may like to think, this is the 21st century. We don't need no stinking mines anymore. But, if they shut them down, they're going to find out whether that's true or not.
Well, I think we're going to need a lot of copper mines, especially if these politicians and central planners want to force electric vehicles, electrification, wind, solar, these types of things. I mean, the current electrical grid we have in the United States, it cannot handle every single person switching over from an internal combustion engine to an electric vehicle. It'll overload our power grid, which is really, really old and is basically kept together with bubble gum and duct tape.
I agree on that, and I've written and spoken about that before. We don't need to beat that to death, but it's very simple. There is no green dream. There is no net zero without mining. The NIMBY thinking and the anti-mining sentiment will have to give way at some point, or they will have to give up on net zero. And I don't think the powers that be will, and I think the younger generations support them. So I think the politicians will see where the writing on the wall is there, and eventually, push will come to shove, and projects will get permitted, and the better companies that are being good corporate citizens will be able to move ahead. But this is definitely a stock pickers kind of market in this way. You can't just throw darts at the board. You can't just look at the company's PowerPoint and how they'll pat themselves on the back about what their great ESG stuff. You need some due diligence here to see who's really doing it and not just talking the talk.
Oh, I 100% agree, especially in this environment where the average retail investor or someone who's a SEC accredited investor or an institutional investor can go and get almost 5% in US treasuries or money market funds because the miners are competing against that now.
Yeah, that's an interesting thing that, it's not just a Wall Street thing. People talking about so-called risk-free real yields now and how competitive that is for equities. Stocks haven't had to compete with bonds for a long time. So now there's this wake-up call, and suddenly, the people on the equity side are all worried about this. But it's not just limited to stocks, it's everything. It's really tough to take somebody and say, hey, look, I want you to invest in this risky proposition. We're going to build this mine. We don't know if it's going to work until we turn it on. We don't know if it will be nationalized, or we don't, we don't know what the government's new royalty plan is going to be, but we want you to invest it in anyway. To convince somebody to do that when they can get something that they think is safe and currently appears to be keeping up with inflation, that's a really tall order.
So you've been predicting a rally in uranium for a while. I know earlier this year you were calling that uranium could have a new bull market and could potentially separate from other commodities. Do you think that uranium could have a bull market even if the rest of the stock market and other stuff melt down?
I'd say it already has. I mean, we just saw a spike up to multi-year highs. We haven't seen prices like this since the Fukushima meltdown. And so I'd say I nailed that one. I'm not one to, I don't want to dislocate my own shoulder patting myself on the back here, but the record is clear on that one.
So sorry, let me ask you another question then that's related. So then you think then if there is kind of a liquidation or kind of a sell-off phase, kind of what's happening in gold and gold stocks the last couple of weeks, you think if that happened in uranium, then it would be a buying opportunity?
Well, that's exactly what I was going to say next. When we started seeing the stocks, at first there was a lot of concern that, okay, uranium's been going up for years, which it had, and the stocks are, they're still in the toilet. So, who cares? And I said the stocks would not get left behind. It would defy all history and experience to think that a commodity can really break out without the equities following, the related equities. And they did. I was right. And the uranium bulls were right. Some people who bought at the previous peak are still unhappy. They may still be underwater, but the market is working and the stocks did move, but they moved with gusto. And that's why we like the stocks, right? They give us leverage to the underlying commodity. Commodities, typically they go up, 1x, and the stocks will go up 4 or 5x. That's why we speculate on them. Great. But they get ahead of themselves. So for the last couple of weeks, actually, I have been saying that I wouldn't recommend that anybody chase a stock that just hit a 52-week high. And uranium stocks, even though they're fundamentally tied to the value in uranium, they're still stocks. And if the broader market weakens, we have seen this repeatedly, where there can be days when the spot price of uranium rises and uranium stocks will fall that very same day. It makes no sense. But it happens repeatedly when the broader markets are selling off. And we've been seeing angst in the broader markets in the last few days in particular. And many of these uranium stocks that just hit 52-week highs or multi-year highs have corrected sharply. Right now, as you and I record, some of these are down 5-10% or more. For all those people who said, oh, he lacks conviction, or uranium's going to the moon, and why is he raining on the parade? This is why. This is what experience says. The stocks go vertical, and of course there's a chance, even without a market correction, just that verticality alone calls for a breather. And you look at the broader markets and the trouble they're in, what we talked about earlier in the interview, the odds seem to favor some kind of market correction. So I think the good news here is that we were right about uranium, and it's not done. By the way, I'm in no way, fashion, or form saying that uranium is peaked. We're just now barely getting to the incentive level that will bring on the new production that this space needs. So I remain extremely bullish on the sector, but I was right to warn against chasing those stocks. They're now beginning to become more interesting for people who are just looking into it. But I think that the broader markets are showing, some real jitters here. So if I did start buying, I would only dip my toe at this point, and I'd hold dry powder back because I think there's a pretty good chance we'll see lower prices in the stocks, if not the metal, ahead.
Yeah, I don't think there's any industry specific or sector specific problems with uranium and nuclear power right now. I think the problems are general macro factors with like the bond markets and credit markets, US Treasury market and other credit markets specifically that are spilling into general stock markets. Let me give an example. So I know a lot of hedge fund managers, and they've been bullish uranium for at least 12 months. They were buying uranium positions, but if they're getting margin calls on other stock positions or other trades, I mean, they might have to sell. If they have a margin call, they'll have to sell whatever's a profitable trade or whatever's already gone up to raise cash to pay off their margin debt.
Yes, absolutely agree. You're quite right about that. But there's also there's a knee-jerk reaction out there. When people start thinking recession again, then they sell energy because oil goes down in a recession, gas, the energy sector as a whole tends to retreat, it always retreats in a recession.
But you had people shorting oil at 60. I mean, I was getting trolled when the West Texas Intermediate Oil Futures contract got down to 65, and I was calling for a rally. This was 7 or 8 months ago. So we knew that the Russian Saudis were going to eventually cut production. They were telegraphing the market, saying that there was oil price manipulation with futures contracts by the U.S. government. And then Saudi oil minister said, look, we're going to start cutting production because oil going below 65 into the 50s is not good for us economically. So we're going to cut production as much as it takes to get the price back up. But yeah, I could see oil correction down low at a certain price point, though. Lobo, I think like that they're trying to balance the market. The Saudis, They don't want the oil price too high or too low.
Yes. Okay. Let's come back to oil. The point to uranium is that you could see, even in the spot market for uranium, never mind the stocks, you could see this knee-jerk reaction. Oh, recession. Oh, that's bearish for energy. Oh, sell everything, including uranium. But I want to really put a nail in that vampire's chest because it's not true. Or rather, I mean, that knee-jerk reaction will happen. That is true, but it's not true that suddenly the demand for uranium is going to go away. Those nuclear power plants, they can't put something else in there.
Well, those are long-term investments. And if you're a manufacturer, and ask the manufacturers in Germany about what happens when electricity costs go up 5x or 10x. I mean, all of a sudden, then you're either closing down your factory or you're talking about moving all those jobs to China or another country.
Right. So the demand isn't going away. Maybe in a recession, somebody delays a construction decision or something in some country, but the mine supply is already in deficit. There are dozens of reactors being built around the world already. And the BRICS countries, they have pollution issues and so on. They have plans for scores more. So, nothing is entirely recession-proof. Like I say, spot uranium could suffer a setback if there's a big fear, or never mind fear, the actual recession starts making headlines. But I would see that as a buying opportunity because it would make no difference to the fundamentals whatsoever. And if it happens, great. I'll be buying with both hands. Back to the oil thing, I think this is quite interesting. We'll see how far OPEC Plus can push this. And there's an open question. And there are people out there arguing that OPEC Plus will keep the oil prices high. They like the current range, 90 to 100 is ideal for them. Over 100 maybe starts creating demand destruction, but 80, 90, 100, that's fine. I'm not sure that they have the power to do that. I'm not sure that they can overcome a global recession, particularly a deep one, no matter what they do. So, I mean, remember in 2020, because of market gyrations, oil prices went negative. So nobody can
for a week. Yeah. For the futures contract for about a week, but the real price was like 20 to 30. The prices were low for a couple quarters and then they bounced back.
Yes. I'm not trying to say that real prices can go that low for any, but the point was that these guys don't control the market. They can influence it, they can push on it, they can pull it, but they can't just push a button and set the price wherever they want it. So I I'm sympathetic to the argument that they will do everything they can to maintain their prices, but I'm not convinced that they have the power to keep oil prices up in the face of a deep global recession. And I do think that's the more likely trend over the year ahead.
Well, if we do have an oil price crash, let's say we go back down to 35,
I'm not
40.
saying a crash. I'm just saying I don't think they can, keep it up. I think losing altitude over the year ahead, 2 steps forward, 1 step back, is more likely than a total crash.
Well, I think the Saudis don't even want the oil price to go to 120, anywhere close to that, because then, like you said, it's demand destruction. It starts becoming even more onerous. So I think they're happy with prices in the 80s, maybe around the 90s. I don't any higher than that in this environment starts to get really bad. But they definitely didn't want. I mean, they were willing to do even more supply cuts if the price went below 65. They were probably going to do even more. Russia did some too. So we could see that type of scenario. If it goes below 65 again, we could see even more supply cuts.
Yeah, I'm not saying it'll even get that low. I'm just saying that I would not bet that if there are recession headlines, that oil and the energy sector as a whole won't retreat.
Well, we'll see what happens, but the U.S. Onshore oil production for the Permian Basin is starting to sputter out. The tier 1 acreage isn't what it used to be, and the cost of production for a lot of U.S. domestic oil producers in the Permian Basin, which is where all of our oil production growth is, it's around 60, 65 a barrel. So it goes.
Yeah, and as you mentioned earlier, Jason, cost of capital. It used to be basically free. So let's drill everything. Now, cost of capital is a major issue for U.S. producers.
Oh, I 100% agree. So all those private oil drillers, so the ones that are not like EOGs, not the ones that are publicly traded, have much higher, much easier access to cost of capital. Their cost of capital is way lower than a private oil driller. The private oil drillers, I mean, they've been with the Fed rate hikes. They were selling their assets to EOG and those guys for the last 6 to 8 months.
Yeah, it'll be interesting to see how this plays out. And it's almost laughable the way the administration, this environmentally sensitive administration, it keeps trying to tell the drillers to drill more. And it's not that the CEOs of these companies are evil or that they want, as you say, $120 oil. It's that they see the writing on the wall and they have real world costs to consider and return on investment to consider, and they're businesses. They're not charities.
Yeah, the government has also made it a mess. I mean, the permitting on federal lands has been an issue. The cost of capital's a lot higher. I see severe supply problems if prices go too low. I mean, we're going to start seeing this. If gold and silver prices go lower, you're not going to see a lot of new mines brought online. There's a couple new mines being finished right now in Canada, like Greenstone, but you're just not going to see the funds raised for a lot of new mines, especially if metals prices are in a downtrend with interest rates at these levels.
Yeah, I would tend to agree. We flipped to, I like to say monetary metals rather than precious metals. And, it's arguable, particularly in a recession. Well, you don't make wires. I mean, you do actually, but gold is not necessary for the economy, some people would say. So why put money there? But at some point, it would be interesting to see how urgent the ESG agenda becomes and what that does for incenting mining projects. It's quite something to see, a Democratic administration throwing billions literally at mining projects in the US or encouraging, billion-dollar loans and things like that. It's, if you had told me this would happen 5 years ago, I might have conceded the possibility, but I would not have bet on it.
Well, isn't it just a press release now? So all that we actually haven't seen any funding yet for yes. Copper mines, right?
Yeah, you're right. It's true.
Well, Biden said when he first took office, I think he said he was going to fund a lot of liquefied natural gas projects with low interest loans for the U.S. to be a liquefied natural gas exporter. But the smaller companies didn't get any of the loans. So, I mean, it's just talk at this point.
It goes to the old saying, how do you know a politician is lying? His lips are moving. But it does mean something, however, that the party that we associate with being anti-mining, anti-resources, is at least talking about how we might need some of it. I mean, it's kind of funny. Remember when sorry, not to pick, I try not to get personal and try not to pick on any particular politician. But you remember when Biden gave his State of the Union address, and he said, he thought he was throwing an olive branch out there. In his most conciliatory, friendly tone, he turned to the GOP side of the aisle and he says, I know we're going to need oil for at least 10 more years. Like, he thought he was being, he was cooperating. He was making a compromise. He was trying to see the other side. And they burst out laughing. Like, he's so clueless that he thinks 10 years is enough to incent, a refinery that takes 40 years to amortize, right?
Well, if we had invested in the actual infrastructure bills the last 15, 20 years, trillions of dollars into our electrical grid and our power wiring and superchargers and electrical vehicle charging stations across the country, maybe then 10 years would be achievable. But none of that has happened. So like all the infrastructure bills, I've lived outside of DC for over 20 years. All these infrastructure bills, every new regime that comes in, or Congress or White House regime, they announce an infrastructure bill and the American people approve it, but then the money actually doesn't get used wisely.
Oh, well, that's a whole nother thing. But oh well, we can talk about the clown world a lot, but that's not really going to help investors out there. I think the takeaways from this are what we've said before. The ESG agenda, no matter how silly it may be, it's not going away. Entire generations want it, support it, and they vote. And I don't see that trend being reversed. But reality does matter, and you've got to have the minds. So,
which commodities then do you think would benefit from the ESG policies? What is it? Copper and some of the other ones, the battery metals?
The copper is number one, because there isn't anything, even including the supposedly hydrogen-based economy, that you're not going to need more copper. The other ones are a bit trickier. I think coming out of the recession, I'm still bullish on lithium, but in due course, that may be replaceable. There are other non-lithium batteries, but I think, it's sort of like, maybe Betamax was better than VHS, but VHS won. And once it became the solution, it carried its momentum forward. That's the way I see the lithium ion batteries we have. For better, for worse, those are the ones we have, and we're going to continue using them for years to come. And that's going to take a lot of lithium. What it doesn't necessarily take, however, is nickel or cobalt. They have the LFP batteries, which are getting much better. They used to have, less range on those, but the latest designs are almost on par with the nickel cobalt batteries, lithium nickel. Anyway, so I'm much more cautious about the other so-called battery metals. I'm not interested in cobalt at all. Nickel, I just see it more as a general industrial metal. But in all of these different solutions, copper is always there. I think lithium still has years to run. And then we'll have to see. It's not a battery metal, but it's the energy metal that we talked about before, and that is different, and that is still uranium. All that power has got to come from somewhere. And you can't build a dam in the desert. And if you don't want to burn more coal, the wind doesn't blow all the time, the sun doesn't shine all the time. Really, there is no way forward for this agenda without nuclear, in my view. And so I'm extremely bullish on uranium.
So I interviewed Justin Yoon from Uranium Insider a couple weeks ago. He said that according to his research and other reports he's read, that there's projected to be a 300 million pound uranium shortfall by 2030. Do you agree with that, or do you think that estimate is off?
I would defer to Justin on that. And to be, I'm not a generalist investor, but I'm a resource investor, and uranium is one of the areas I cover, whereas Justin focuses on that alone. I know that some people are mad at Justin because, he was, perhaps bullish, maybe a little too bullish at times. And some people maybe got burned when stocks didn't keep going up or whatever. But, he is the Uranium Insider. And for whatever it's worth, I'm not an affiliate with him. He doesn't pay me or anything like that. But I have enormous respect for his knowledge, and I have a lot of time for Justin. I listen to what he says about the market.
Yeah, I mean, other than some hedge fund managers that read all the uranium reports, the company reports, I mean, as far as I'm concerned, I think he knows more about the uranium market than almost anyone else, probably even more than Rick Rule, since he does this every day.
Right. And Rick also covers, like me, Rick covers other areas, whereas Justin is focused on this. And good for him. It's good that we have someone like that out there.
So, last question here. I want to ask about Chinese demand for commodities. Do you think that there's still going to be long-term demand out of China for food, energy, industrial metals, even if China goes through a very painful period with a credit bubble, housing bubble in the next 5 or 10 years?
Oh, well, so very long term, yes, no question. I'm very skeptical that there will be a painful 5 to 10 year scenario. People have been talking about the impending implosion of China for the entire time I've been an investor. I can't remember a time where there wasn't people warning about China having grown too far too fast and being ripe for a fall. So it's not that it can't happen, but I mean, come on. You can't have a scare like that every year forever and not start to take them with a grain of salt. But that aside, like that's more of an intellectual or philosophical issue. Just like you look at the reality, Beijing isn't going to take this line down. If all the things that they've done don't get things going again, they will do more. And unlike, say, the United States, which if it wants to throw a bunch of money at a problem, has to print it, China still has massive reserves. Like they've actually got the cash in the bank. They could throw a lot of money at their economy without printing anything. So I'm not pro fascist dictatorships in China or anything. I'm a libertarian anarchist. So I'm not saying the Chinese have it all figured out and they're the best in the world. That's not the point. The point is, don't discount them. And beware of people who say this is the year that China goes down in flames, because that happens every year. And don't forget that they have an enormous war chest and the willingness to use it. So, we'll see.
Well, it also seems like Chinese policy, when they run trade surpluses, they prefer to just build a new giant warehouse and fill it to the brim with copper or base metals instead of buying U.S. treasuries, because they're not buyers of U.S. treasuries. But as a libertarian, I agree with you. I mean, they've obviously misallocated a lot of capital to, there's ghost cities, there's empty apartment buildings that as soon as they're built or partially built, they collapse. So that's a waste of iron ore, steel, copper, those industrial metals. But there's still, I think, demand for those things long term.
Yeah, and they used to have X trillions of dollars in reserves, and now I think it's something like 0.75x or something. They've spent a lot. But think about that. They could build more ghost cities, bulldoze them, and do it again just to stimulate the economy. And they could do that without going into debt.
Well, yeah, they have their trade surplus dollars, so they still are running trade surpluses, and the cash has to go somewhere. I don't think they're going to hold a lot of U.S. dollars or U.S. treasuries long term. Well, clearly with the data we're seeing, they're not holding U.S. treasuries, buying more U.S. treasuries long term.
Yes, they are liquidating, but they still have a lot. And so, and I'm also not saying that China can't go lower, that China's woes will be easily dealt with. I think if they are the factory of the world and the world is going into a global recession, that's bearish for China, no matter what. So I'm not saying I see no downside. In fact, my base case outlook is for more downside in the near term, in the next couple of quarters, I mean by that, for China and the global economy. But just, I'm never say never, not saying it's impossible, but I think it's very dangerous to make large financial bets on the assumption that China's going down in flames anytime soon.
Yeah, I'm just reading some of these headline articles about the industrial miners, so like Rio Tinto and BHP, that like anything related to a lot of the industrial metals, specifically like iron ore and steel and aluminum, like those, to avoid those for many, many years. So the sentiment is just super, super bearish.
Yeah. And, there's an opportunity here for the long-sighted contrarian. If you have the patience and if you can look for juniors that will look at things that are out of favor and have the cash to pick up some great assets while they're at fire sale prices and then just sit on them, land bank them, wait for the prices to come up. I don't recommend a lot of land bank type plays in my services because they require a lot of patience. But if they're done well, they actually can deliver for shareholders.
So what exactly is a land bank?
A land bank is a company that acquires known resources. They're not an exploration play. They're not going to go and make a discovery. They acquire previous discoveries that didn't get turned into mines while prices are way down, and you bank it in the ground instead of spending all that money building a mine, purifying the metals, and then putting it in a vault in a bank above ground. You just leave it in the bank of the ground where it can't be stolen, and you wait for metals prices to go up. Then you and your shareholders can benefit from that change in value.
So it's a whole, they're buying the cheap mine as kind of like a holding asset, and so they're waiting to flip it after a rally, a bull market restarts to a producer then to build a mine.
Yeah, you could almost think of it as being like a real estate play. Like you buy shopping centers when the economy's down and they're on sale, and you don't even have to build them or jazz them up again. You wait for the economy to go up again, and then you sell them.
And if they can put a royalty on that and then get the cash flow, keep the royalty, and then they sell it, then that's even better.
Yeah, if they can do that too. Now, the problem is that many of these land bank plays, even ones that call themselves consciously a land bank play, they'll fall off the land bank bandwagon. They'll get the explorer's bug, and they'll decide, oh, well, we're just going to poke a few holes here. We think we can make it bigger. And if you're right, great. But if not, you've spent that money that you needed to be able to wait for higher prices. Now you spent it, and the drilling didn't work out. You got to go raise money, dilute your shareholders. So you really need to deal with management that you trust to stay the course and not get all excited, not want to go out and start playing with big yellow trucks.
Yeah, it sounds like most people are not very good at that, but you have over 15 years of expertise doing this. And speaking of management, like you said, you get one-on-one phone calls. A lot of people don't. They have to go to these conferences, and they have to send out a lot of emails and phone calls to get any attention from management. But since you have a track record, you're writing for Casey Research, you're friends with Doug, you get access.
Doug did me a big favor. It was good to be introduced by Doug, and his contacts largely became my contacts in the industry. It was a tremendous advantage, and I what can I say? I will always owe him a debt of gratitude. He was a great mentor, and Rick too, by the way. Even though I never worked for Rick, he took me under his wing. He taught me so much. I mean, he literally took like a day out of his busy time to sit down with me and teach me about the oil patch. And that's huge coming from somebody whose time is so valuable.
A lot of people aren't aware Rick actually worked at an investment bank, and he was an oil analyst, and he was doing oil deals early in his career.
Yeah, we just I don't want to wax too rhapsodic here, but it's great to have good mentors, and I'm trying to teach my team as much as I can and pass it on. And frankly, I think everybody wants a stock tip and all that, but I think the most valuable thing I do for my readers is education.
Yeah, I agree. It's really tough. There's a lot of marketing spin. Because there's not capital available, you're not seeing a lot of juniors going and like hiring podcasts or YouTube channels to do pump and dump anymore. So thankfully that's going away.
Mm-hmm. I think you're optimistic. It'll come back.
Yeah, it'll probably in uranium. Yeah, it'll be back. Whatever commodities going up. So what, it was the crypto, some of the crypto mining companies, whatever commodities going up, it cycles in Vancouver.
Markets are cyclical.
And so is pump and dump, because like the regulators, I guess, in a lot of cases don't really care.
Yeah, that was my point. You can see the degree of pump and dumpness, as if that's a word, as a market indicator. Speaking of Doug, he taught me something that he didn't have the word for it. I called it the bathroom index. And that is how many people follow you into the bathroom when you're at a trade show to talk to you or ask you about mining companies or whatever. And when a bunch of people follow you into the bathroom, like they won't stop asking you questions, then you're near a market top. When you can go to the bathroom in peace, then it's time to buy.
That's pretty funny. There's actually a lot of people aren't aware of this. So there's a bunch of shell companies in Vancouver and they switched. So like these shell companies don't really die. They just stay there and then they own a bunch of different assets. And so whatever commodity price, is going up, all of a sudden that company has a new investors presentation. Oh, they're a nickel play. Oh, they're a uranium play. Oh, they're a crypto mining play. It just switches. The investors should be aware of this and look at the actual filings and see what the company owns.
Yeah, these things really are, calling a cat with 9 lives might be too generous. It's more like an undead ghoul of some kind. Doesn't matter how many times you shoot it, the darn things just keep get up and walking again. I don't know how they survive. They go live in their grandmother's basement for a year until the market comes back. The markets go south and they run out of money. And you think, oh, they're going to go bankrupt. They've got $5,000 left and $500,000 in debt. How are they going to survive? But somehow 3 years later, there it is again. That same company is risen from the dead.
They're pretty creative with how to survive. It's pretty. I've heard some of the stories. I won't go into them on a podcast. It's pretty crazy.
Likewise.
Well, last question before I let you go. So it sounds like a very difficult environment for capital raising for the majority of juniors. I know you can find the good ones, but a lot of people out there are susceptible to the marketing schemes. Do you think that this type of environment with interest rates, tough to build a mine, are the royalty companies going to benefit here? Because if I'm Franco-Nevada, I can make a phone call and I could give quality juniors, I can go fund them for drilling. I could get a royalty. If a mining company has some trouble finishing a mine, I could go buy a stream. Seems to me these larger precious metal royalty and streaming companies that have good profit margins and free cash flow, they don't have to worry about their costs going up. They're in the driver's seat because Franco-Nevada has all this cash and all these options for either buying royalties from juniors to fund drilling or helping a mining company that can't get the capital to finish a mine.
Well, if it's a mining company, they should have the capital to finish the mine. If it's a developer that, they just did their feasibility study and they haven't raised the capital yet, that's different. But if they're a miner and they can't raise the capital to build their expansion or whatever, that's actually a red flag. But your idea is a sound one. The only thing I would add to it is it's one that would take time. If you're going to fund particularly exploration, but also even development, typically that's going to be a couple years before that starts producing cash flow. So yeah, you might be able to get some great royalties now that you wouldn't have before, or better terms on the royalty, or you might be able to add a larger portion of the output to your stream or something than you would on a frothier market. But it would take a pretty long-sighted shareholder to get all excited about that acquisition now, before the mine is built, and there's risk involved too with whether it's built or not. So yes, I agree with your idea, and with something to watch out for in the royalties. Are they able to bag some much better acquisitions at these times? That's what downturns are for. But I wouldn't necessarily expect the share prices to soar in the downturn.
Yeah, I mean, right away, so like shares of Franco, they're going to go down too, but they're going to do smart long-term deals. Let me just name a case study. So you mentioned a red flag. Actually, one of the best deals Franco-Nevada did in the last 10 or 15 years, they bought a gold stream from the silver miner Coeur d'Alene on the Palmarejo mine in Mexico. And they bought about $1 billion worth of cash flows and net present value for about 80 million because Coeur d'Alene, when the markets froze up in 2008 to finish the mine in Mexico, they couldn't raise any capital. So Franco had the capital. They paid the 80 million gold stream. They saved the miner from going bankrupt, and boom, they got a gold stream and cash flow when the mine finished. And the stream had to be adjusted eventually years later. But those types of deals, as a contrarian, those are amazing. So they're not going to show up in the stock price initially, but a few years later, I mean, they're just minting money from it.
And the good news is, if it doesn't show up in the stock price initially, value has been added, but price hasn't accounted for that. And there's an opportunity in that.
Yeah, so I think we're going to see a similar type of scenario because the cost of capital for a lot of the gold and silver miners, especially the small and medium-sized producers, the cost of capital is sky high now. There's going to be dislocations, I think, in the royalty companies. The larger ones are going to pounce depending upon credit conditions in the next 6, 12, 18 months. I think we're going to see some opportunities for them to pounce soon.
I would agree. I also think we're going to see more M&A, and that can be a very good thing. If you own shares in the takeover target and there's a premium offered, then that can be a great win, even in a down market. But on the junior end, I would beware of mergers of convenience, may not be the right word, but keep the lights on kind of mergers. Two companies that have modest treasuries, they put them together and now they have enough to keep the lights on for another year. That's not a really good thing. A better one would be, company A has a deposit but no money, company B has money but no deposit. You merge those together, and then maybe you have something that can slog through the downturn. But again, due diligence is required. Beware of M&A activity that doesn't really help shareholders.
And I'm sure you can help people with that with the Independent Speculator. Please tell my listeners more about your newsletters.
Well, thank you very much for saying that. Of course, the flagship service, the Independent Speculator, is built around a portfolio of it's the Brent Cook recipe. It's my own investments. It's not just that I disclose some of them, but the whole idea of it is skin in the game, and it is a portfolio of stocks I'm willing to put my own money into. That's a pretty normal newsletter in a way. It's what people expect. The service that people don't understand is my take. And I would recommend people go to my YouTube channel and the Independent Speculator. There's an explainer video because it's more like Consumer Reports. There's no portfolio. I don't recommend stocks, but I cover literally hundreds of them at the request of clients. So it's for all those people who come up and say, "Hey, Lobo, what do you think about this?" And I'm not legally allowed to answer that question one-on-one, but I can do it in print. And I have a team now that helps me, and we cover these companies every month. If there's major news, we update the database, and you can sort that database by company type or commodity, metal, whatever stage of development. And so you can use that database to create shopping lists or sell lists or different lists. So it's really a very different sort of thing than most. I shouldn't say most. I'm unaware of any other newsletter like it. It's not really a newsletter. The core of the service is a database of independent, unbiased company evaluations. And if you're not sure if any of this is for you, then I always encourage people to please sign up for my free weekly letter. You can read it, see if you like the way I think, see if it makes sense. And I promise that if you do, we won't spam you with a flood of daily advertisements. I hate that stuff. You get one email per week.
Sounds good. And if we do have commodity prices in this kind of global macro event that collapse further, sell off, I think we're going to have more supply side problems in the short term, because cost of capital for a lot of these commodity producers, unless you're like an ExxonMobil or a Chevron or Franco-Nevada, cost of capital for a lot of these other companies is very, very high. That's going to create supply problems in the not too distant future. And then demand's going to come back once the central banks start flooding liquidity again.
And that's how I see it too, Jason.